Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Sei-wan, professor of economics at Ewha Womans University. Professor Kim, good afternoon. Thanks for making time today.
Good afternoon, Devin.
Well, let's start with Wall Street, where stocks overnight were down again by quite a bit. Obviously, the Ukraine situation weighing on investors around the world. For the Dow, it was the fourth decline in a row. The S&P now, year to date, is down about 10%. What's the story in the global markets?
U.S. Stocks dropped in a volatile trading session Tuesday that pushed the market into correction territory as tensions in Eastern Europe escalated. Major stock market indexes closed down over 1%, hitting its lowest level in more than 4 months, as investors digested the consequences of Russia's deployment of soldiers into Ukraine. The Dow Jones Industrial Average ended the session down 1.4%, while the Nasdaq Composite, which suffered a correction in January, declined 1.2%. According to my calculation, Dow is off 8.7% from its January record, and the Nasdaq is 17% below November's high. In today's market, Japan's Nikkei dropped by 1.7%, but Chinese markets in Shanghai and Hong Kong gained 1.9% and 1.5% respectively.
Well, here in Korea, we're seeing volume on the stock market come down. Investors maybe staying on the sidelines to see what happens. This month, volume's down by more than 11% compared to last month, and compared to a year ago, it's down more than 43%. Tell us about that and what's causing this precipitous drop in trading volume.
The rapid drop in stock transactions in domestic markets indicates investors' rising fears on ongoing issues in the threat of war in Ukraine, global supply chain disruptions, inflation, and central bank interest rate hikes. Also, the increased uncertainties related to presidential election in March added another factor of shrinking stock trading. As you said, the decrease of stock transactions in February was 11% on month and 43% on year, which is one of the largest monthly transaction drops in years. If this drop in transactions continues until the end of March, after presidential election, it could be understood as a sign of domestic market correction over a longer period, like over 1 year.
Well, today the Kospi did in fact close higher. Looking at the biggest names, it was kind of a mix, but some strength in energy-related shares and especially shipping-related names. The exchange rate the recent days has been coming down a bit too. Tell us about the domestic market.
Like in the other foreign markets, the threat of war has become the latest wild card for investors who were already concerned with supply chain disruptions, rapidly rising inflation, and central banks' plans to tighten monetary policy in domestic markets. Domestic market marginally gained today because too much recent drop have made some investors to buy stocks at lower price today. The benchmark Kospi gained 0.5%, and Kosdaq also gained 1.1% today. Most of large cap stocks traded lower today. Samsung Electronics retraded 0.5%, but the second largest cap stock, LG Energy Solution, also gained 0.5% today. Individual investors and institutional investors led Kospi market rise together by about 255 billion won. In Kosdaq market, individual investors net bought 48 billion won and led the market rise today.
Well, now zooming out, Professor, another issue so far this year, as of February 20th, Korea has a trade deficit of about $6.5 billion cumulatively. And that deficit's building by about $130 million a day. The government, of course, is also running on a deficit, as it has been for several years now, but especially in the pandemic. There are concerns about the combination of these twin deficits. What do you make of the situation, Professor?
Korea faces the first 3 months of trade deficit in 14 years. The prospects have sent alarm bells ringing in the export-dependent country since it is already suffering a physical deficit due to expanded welfare coverage, of course, related COVID pandemic. According to government's announcement on Monday, Korea suffered a $1.68 billion trade deficit in the first 20 days of February due to rising prices of oil imports. Korea's trade balance shifted into the red for the first time in 20 months last December and has stayed there until now. Normally, Korea enjoys one of the world's healthiest annual trade surpluses for years. Also, Korean government's debt approaches is largest size in history at 1,075 trillion won, or over 50% of GDP. So, a special attention should be given to those two deficits for avoiding uncontrollable economic shocks in the future.
Well, finally, Professor, at the financial services company Nomura, Robert Subaraman, the chief economist for Asia, sees Korea's economic growth this year coming in significantly lower than the general consensus. He says 2.1% compared to the 3% forecast by the Bank of Korea and the IMF, with growth in exports slowing down and domestic demand as well. What's his point of view and your own as well?
According to recently released report from Nomura Securities of Japan, this year's Korean economic growth will be limited at 2.1% level, which is much lower than those of IMF's and Bank of Korea's over 3% economic growth for this year. The report argues also that the main factor of slower economic growth in Korea is the slower growth in China, which says if China grows slower, then Korean export is not growing as before. The report also finds other factors like Bank of Korea's interest rate hikes at least twice for this year, strict restrictions on bank loan, which interrupts the rise of domestic consumption and investment, and increased uncertainties related to next Korean president. All these provide negative impacts on Korean economic growth for this year. Actually, I don't 100% agree with all the details of this report, but this report actually calls attention to smooth control and smooth harmony of fiscal and monetary policy for this year.
Well, Professor, we'll have to leave it there for today. Thank you, as always, for sharing your insights with us. We appreciate it.
Thank you very much.